Well, it is a Friday, and it is time to talk a little dollars and cents with our good friend Davis Garrison from Preservation Financial Group right here in the Johnson City area, and talking today a little bit about retirement and the couple of different sources that go into retirement. And Davis, always good to have you back on the show.
Thanks, Amy.
Getting ready for a big weekend.
Yes.
We were talking about Battle of the Bucks, and we say you do Battle of the Bucks in a totally different way, don't you?
Yes, I do.
Well, let's talk a little bit about retirement and the two major sources that people see when it comes to their retirement.
Okay, the two major sources that people utilize in retirement is number one, Social Security, and retirement plans, employer-sponsored retirement plans, 401ks, 403bs, that type of thing. And there are several techniques that you can use to minimize taxation. Taxation is a big thing. Social Security, a lot of people don't know it, but if you're single and make between $25,000 and $34,000 a year, 50% of your Social Security is taxable.
50%?
50%.
So half.
If you make over $34,000 a year, 85% of it is taxable. And people just are stunned by this. But no more than 85% of your Social Security benefits are taxable. So 15% is free gratis.
Okay.
But there are several ways that you can offset this taxation. And the levels of taxation are from your adjusted gross income on your 1040,
okay,
plus non-taxable interest. People think municipal bonds are free from taxation. They're not. Plus 1/2 of your Social Security benefit. And also, in addition to Social Security, you have employer-sponsored retirement plans, 401ks,
right.
And at age 70 and a half, you have to start taking required minimum distributions. The federal government the IRS gives you the opportunity to delay or defer taxation. You're penalized if you start withdrawing prior to age 59 and a half, but you have to start taking it at age 70 and a half. And I wanted to read it because there's a lot of confusion about required minimum distributions. And it says that required minimum distributions, the IRA owner or plan participant must generally take their first required minimum distribution during the year in which he or she turns age 70 and 1/2. However, the first RMD payment can be delayed until April 1st of the year following the year that they turn 70 and a half. You got all that?
No, so the year following the year they turn, but that's basically the same.
They can defer it until April 1st of the following year that they turn 70 and a half.
And who would that benefit? Why would someone want to look at something like that then?
Well, as RMDs are included in the calculation for Social Security taxes.
Okay.
So one technique that we use is to have clients start drawing down their IRAs first. Number one, that's going to reduce the amount that the required minimum distributions are figured on.
Okay.
So that's a good technique. Plus, you're deferring taking Social Security every year that you wait between age 62 and age 70. It increases 8%.
It's a little bigger.
And in this zero interest rate environment, 8% is a pretty good incentive to wait. And so you can balance things using techniques like that. Another way to minimize the taxes on your Social Security is if you have an IRA, convert all or partially to a Roth IRA. Roth IRAs, unlike municipal bonds, do not count against your Social Security. And there are no required minimum distributions for Roth IRAs. So there are techniques that we can use. Come by or call the RMD information we'll send to you. You can come by and pick it up. We'll print it out for you. But they need to know this. And you have to take your RMDs, because if you don't or undertake what you need, then there's a 50% accumulated value tax penalty.
And you don't want that.
You don't want that.
All right, well, certainly a lot of information. If you would like him to explain a little bit further, you can always call his office. It is Preservation Financial Group right there on Sunset Drive in Johnson City.